The stock market should already be in ruins. Um, every single warning sign is screaming danger, but it keeps climbing. And when you find out what's actually holding it up, you'll understand why the collapse, when it comes, will be worse than anyone expects. Hi, my name is Bob, and I've spent the last 20 years working in finance and banking. I have a finance degree and an MBA. And honestly, even with all that education, I used to look at the markets and think, this makes zero sense. The headlines were screaming recession. Inflation was destroying purchasing power, but the market just kept going up. Then I discovered something that changed everything. Um, Markets don't crash when things look terrible. They crash when the invisible forces propping them up finally snap. Once you see these forces, everything happening right now becomes crystal clear. So make sure to stay until the end to really understand when the market will crash. Leave a like and let's start. Here's what's happening. Every major indicator is pointing to a market crash that should have already occurred. Warren Buffett, one of the smartest investors alive, is sitting on mountains of cash. Why? Because of a market valuation metric most people have never heard of. Buffett looks at the total market capitalization of all public companies and divides it by U.S. gross domestic product. Right now, all U.S. public companies are worth about $66 trillion. The entire U.S. economy produces about $30 trillion per year. Divide 66 by 30, and you get 220%. Here's the terrifying part. Anything over 100% is considered dangerously overvalued. Um, Before the dot-com crash in 1999, this ratio was at 115%, not 200, not 150, 115, and the market still crashed by over 60%. We're almost double that level right now. But it gets worse. Let's talk about price to earnings ratios. Historically, companies in the S&P 500 have PE ratios around 15 to 16. That means investors pay $15 for every $1 the company earns. Today, the average PE ratio is between 25 and 28, already elevated. But that's not even the scary part. The companies driving the entire market are trading at insane valuations. Nvidia has a PE ratio between 53 and 55. A stable, mature company would be around 20 to 25. Amazon is trading at 35 to 37. Microsoft is between 35 and 40. And here's the one that should make everyone pause. Tesla has a PE ratio of 286. That means people are paying almost $300 for every single dollar Tesla earns. Would you pay $50 for a $1 candy bar? That's essentially what's happening in the market right now. And here's something that should terrify anyone paying attention. Before the dot-com crash, S&P 500 PE ratios were running between 29 and 32, roughly the same levels we're seeing today. History is literally repeating itself right in front of us. So, with all these warning signs flashing red, why hasn't the crash happened yet? This is where things get really interesting. Even though every indicator is screaming danger, high inflation, record consumer debt, weakening job market, widespread layoffs, slowing corporate earnings, elevated PE ratios, and a grossly overvalued market, the whole thing is still standing. There are two major forces working behind the scenes to hold everything up. And once you understand them, you'll see exactly why this delay makes the eventual crash even more dangerous. Force number one is government stimulus that never really stopped. Yes, the stimulus checks ended years ago, but look closer. The government is still pumping money into the system in ways most people never notice. Expanded credit programs, quietly increased government spending through tax cuts and subsidies. It's stimulus wearing a different disguise because they don't want anyone to see it for what it really is. Think about the numbers. The government collects roughly $5 trillion every year in tax revenue. but it spends about 7 trillion. That extra 2 trillion has to come from somewhere, and it flows into the economy. Companies receive government contracts, employees get paid, those employees buy products, corporate profits stay elevated. It's a circular system that keeps demand artificially high. But here's the question nobody wants to answer. The national debt is now $38 trillion. The annual interest payments on that debt are over $1 trillion. How long can the government keep spending 2 trillion more than it brings in before the whole system breaks? Probably not much longer. And this isn't even the main force holding everything up. Force number two is dollar devaluation and inflation working together. If you've been following economic news, there's been talk about weakening the dollar to make exports cheaper. That's not a secret, but there are other less obvious factors quietly decreasing demand for the dollar. First, several countries, particularly the BRICS nations, led by China, want international transactions settled in currencies other than the dollar. And it's happening faster than most people realize. Every transaction that moves away from dollars decreases global demand for the currency. Second, U.S. Treasury bonds aren't seen as the ultimate safe haven asset they once were. When foreign investors and governments lose confidence in U.S. debt, they buy fewer Treasury bonds. That also decreases demand for dollars. When demand for any currency drops, its value falls. Combine that with deliberate policies to weaken the dollar for trade purposes, and you have serious downward pressure from two different directions. And it gets more complex. Inflation has been stubborn, refusing to come down. A weaker dollar makes that worse. When the government floods the system with more dollars through deficit spending, inflation accelerates even faster. Why? Because you have more dollars chasing the same amount of goods and services. Basic supply and demand, prices rise, and when the supply of anything increases, the value of that thing typically goes down. That's exactly what's happening to the dollar right now. Every dollar you hold is quietly losing purchasing power, even if your bank account balance looks the same. But here's where it connects back to the stock market. Government spending supports consumer spending, which drives inflation. At the same time, the dollar is losing value. The result? Companies raise prices. When prices go up, revenue goes up, earnings go up. Not because companies became more innovative or productive, simply because the dollar doesn't buy as much anymore. This is why corporations can report record earnings even when fewer people are actually buying their products. It's not real growth, it's inflation disguised as growth, but the earnings still increase on paper. And here's the part that will blow your mind. Wall Street knows this. Some big investors are betting on exactly this scenario. They understand that inflation can lead to higher corporate valuations, even if the underlying business hasn't improved at all. But there's something else happening that most people will never hear about on mainstream financial news. If you borrow money to buy assets like stocks and inflation rises, two powerful things happen in your favor. Your debt becomes cheaper because you're paying it back with less valuable dollars, and your asset values increase because replacement costs go up and companies can charge more for their products. Inflation actually works in favor of people who buy assets with borrowed money, and money is still historically cheap to borrow. It's likely to get even cheaper if the central bank cuts rates. Big institutional investors and hedge funds are borrowing massive amounts to buy stocks. If inflation stays high or increases, they win huge. These two forces, government spending and dollar devaluation, are working together to artificially prop up the market. They're keeping large investors in the game, and here's what the government, the banks, and the wealthy don't want regular people to understand. The top 10% of Americans own almost 90% of all stocks. 90%. So as inflation and dollar devaluation continue, the wealthy get richer because their assets increase in nominal value. Meanwhile, the bottom 90% watch their cost of living rise and their dollars buy less and less. The pressure builds until something breaks. But these forces propping up the market won't last forever. They're delaying the crash, not preventing it. So, why is this crash taking longer than expected? This is the biggest question. If all the signs point to disaster, why hasn't it happened yet? Most people misunderstand how crashes actually work. Crashes don't happen when economic conditions get bad. Crashes happen when confidence breaks. Think of confidence like a bridge that's overloaded. It doesn't collapse when the first crack appears. It collapses when that final support beam snaps. Right now, confidence is being held together by three fragile threads, and all three are starting to break. Thread number one: consumers are still spending money they don't have. The U.S. economy is consumer driven. Consumer spending makes up roughly 70% of GDP. But personal savings rates are near historic lows. Credit card balances are at all time highs. People are spending money they don't actually possess. That's not sustainable. When consumers finally stop spending, corporate earnings fall and markets follow. Thread number two: the labor market has held up, but cracks are showing. The so-called no hire, no fire labor market is disappearing. Companies have stopped hiring. Layoffs are increasing. It's not a strong labor market. It's a lagging indicator that always shows weakness right before major downturns. Fewer employed people means less consumer spending. The cycle reinforces itself. Thread number three: interest rate cuts won't save us this time. In previous economic cycles, lower interest rates gave markets a cushion. Money became cheaper, asset prices stabilized or recovered. But today's economy is running on high debt, high costs, and consumers who are already maxed out. Lower rates won't magically fix any of that. And this brings us to the most critical part: the cycle of false confidence that always appears right before major crashes. Here's the truth nobody wants to hear: crashes never appear out of nowhere. They're always preceded by the same pattern, and all three phases are already happening right now. Phase one: um, markets stay elevated far longer than seems rational. We're deep into this phase. People are confused and frustrated because the market feels completely disconnected from economic reality. That's exactly what happens before every major collapse. Phase two: investors become numb to bad news. It's called crash fatigue. People hear terrible headline after terrible headline and eventually stop reacting. Inflation reports, corporate layoffs, earnings warnings. The response becomes whatever. I've heard this before. This is classic pre-crash behavior. Bad news stops moving markets right before it actually matters. Phase three: a confidence breaking event hits. It's often not dramatic. Sometimes it's small. Major bankruptcy, credit default, a large company badly missing earnings estimates. That single event triggers a chain reaction. Confidence shatters. Selling accelerates. The crash everyone expected months or years ago finally arrives, and confidence might already be breaking. Recent consumer sentiment data showed a significant decline to near record lows, well below what economists predicted. Here's why crashes feel sudden when they finally happen. People mistake delay for safety. They think if it hasn't crashed yet, maybe it won't. But delay actually creates something worse. The longer a collapse is postponed, the faster and harder it hits when it finally arrives. Here's what banks and financial institutions really don't want you to understand: the market hasn't crashed yet, not because the economy is strong or healthy. It's being held up by temporary forces. Government deficit spending that can't continue forever, dollar devaluation, and inflation that benefit the wealthy while crushing everyone else. And when those forces weaken or reverse, the market won't gradually decline in an orderly way. It will snap back to reality violently and suddenly. The crash isn't canceled, it's just waiting in line. And the longer it's delayed, the bigger and more destructive it becomes when it finally hits. This isn't about predicting doom or spreading fear. It's about understanding the actual mechanics of what's happening so you can make informed decisions. So you can protect yourself instead of being caught off guard when everyone else panics. If this helped you see through the noise, hit subscribe and check out the next video. See you soon.